Let's look now at profitability ratios. And actually there are several of these, and they're not all exactly the same. They do look at different concepts. I'd like to start with the first two. We have the operating margin and the profit margin. And just to possibly confuse you a little more on this, they could have some very similar sounding names. The operating margin might also be called the operating profit margin, okay? But the key word there is operating, because we are talking about operating income or operating profit, otherwise known as EBIT, earnings before interest and taxes. And then down here, what we sometimes just call the profit margin might also be referred to as the net profit margin. So if you do see the word net, don't let that throw you. It just further emphasizes that here we're looking at net income and not some other measure of income. Alright, in both cases we are comparing our profitability measure, be it operating income or net income, we are comparing it to sales. And here's the idea. If you look at the income statement, let's just do that here. Looking at the income statement, at the top we see that we have sales of $7,035,600. Do we get to keep all of that in profit? Does that mean we made $7 million in profit? Well, of course not, okay? You know that by looking at the statement, and you would know that anyway because any business has costs. Now the question is, how much does it get to keep in profit, percentage-wise? For every dollar in sales that it makes, how much does it get to keep in profit? The reason that we have two ratios here is that we might want to look at two different measures of profitability. We might want to see how much of it results in at least operating profit. So the operating margin that we discussed would be calculated by taking this number, $492,648, and dividing by the sales figure of $7,035,600. And we do that over here. We take EBIT and we divide by sales, those two numbers I just mentioned, although these are in thousands. If you divided those two numbers, you would get 0.07 on your calculator, or 7%. And that tells me that looking at the income statement, for every dollar of sales that I start with, by the time I get down to operating income here, 93 cents on the dollar has been lost to expenses. Most of it cost of goods sold, then we have other expenses and depreciation and amortization. By the time we get here, only 7 cents of each dollar of sales remains as operating profit. So our operating margin is 7%. What about our net profit margin, or simply profit margin? That's the second of our two measures here that we're going to take a look at. Well, let's go back to the income statement again and go on down to the bottom of the statement. Here we have net income as the last line. And looking at net income, I can see that that's $253,584. So a little bit more has been lost, right? We've taken out interest expense, we've taken out taxes, and so when all of that is finally taken out, we've got $250,000 or a little bit more than that. So we've lost a little bit more to interest expense and to taxes. So the question now is, how much is left? And of course we know it's going to be a little bit less still. So the net income divided by sales is going to be that profit margin, that net income, $254,000 approximately, divided by the sales figure, the same number, and we've got 3.6 cents on the dollar. 3.6%. I do want to point something out about your calculator. If you have a TI BA2 Plus calculator and you were to do 253.6 and divide that by 7036, especially if you've gotten the calculator recently and haven't changed any of the settings, it's likely that you're going to see this on your display. Okay, it's going to say 0.04. And of course, what do you think that means? Well, 0.04 in decimal form, that's 4%, right? But the answer is really 3.6%. This calculator didn't show you enough decimal places. Now, why is that? It's kind of annoying. And how can we fix it so that you'll see what you need to and perhaps avoid missing a question? Because for small numbers like this, 0.4 percentage points, that 4/10 of a percentage point actually can matter. All right. So how can we fix this? Well, you may have noticed if you've just gotten a TI BA2 Plus calculator that when you get it out of the box and start using it, that everything is shown with 2 decimal places. Every single figure, every single result of a calculation is 2 decimal places, whether you need it or not. Okay, and we all know that sometimes there are numbers that you don't really need to see any decimal places, and then other times you need to see more than 2. In this case, where you need to see more than 2, it's more than just annoying. It can actually leave out some important information that you need to see. So how do we fix this? Well, some instructors recommend that you change the number of decimal places to 4 or 5. And that's okay, you can do that. To change the number of decimal places, by the way, if you haven't done this, you probably should. You're going to press the second button. Notice that the second key is up here near the upper left-hand corner. And then push the format key down here on the decimal point. So second, format. And immediately you'll notice there's an option to change the number of decimal places. It says 2 here. Obviously you can see that, 2.00. It's showing you 2 decimal places. Some instructors say change it to 4 or 5, and if we changed it to 5, we could press 5 and then enter, and you can see instantly that change has taken effect. We see 5 decimal places. But I don't actually like that quite as much as just using floating decimal point. Floating decimal point, the setting for that is actually 9, and that's what I recommend. So I'm going to type in 9, and then I'm going to press enter, and then I'm done with it. Okay, I'm going to go back out by pressing second and then quit, and I'm done. Alright, now I can put in 253.6 and divide by 7036 like I had before. And the result is going to be, it's going to show us, just like a normal calculator would, it's going to show us all the decimal points that it can handle. Alright, and you're definitely going to see it's more like 3.6% is our answer. And if we hadn't needed any decimal places, then it wouldn't have shown us any. Basically, floating decimal point is nothing fancy. Floating decimal point is basically what any normal calculator does. It shows you as many decimal places as you need, and in those cases where you need a bunch, it will show you as many as it can fit on the screen. Okay, so going back over here, leaving the calculator talk aside for the moment, I think we've taken care of that. Looking at these ratios again, I want to see how is DeLeon doing with its operating margin and its net profit margin. We see that its operating margin is 7%, meaning that by the time we get down to EBIT on the income statement, we've already lost 93 cents on the dollar of our sales revenue. We've lost 93 cents of each dollar to expenses, leaving only 7% of that left. And then by the time we get down here to net profit margin, we have lost another 3.4%. We're down to 3.6% of our original sales figure. We would like to have this be higher if at all possible. So what do we have? For DeLeon on those two ratios, it was a couple of years ago lower, 5.6%, 2.6% for operating and net profit margin respectively. Then in the next year it was actually negative. Why is it negative? Well, because it had a net loss that year if you look at its income statement. And then in the most recent year, 7.0%, 3.6%, actually those look okay. No big concerns there really, because those are pretty close to the industry average. Looks like DeLeon is kind of getting back to about where it should be, at least in this area, okay, for operating margin and for net profit margin. Okay, now there was another profitability ratio on that page that I did not talk about that I should now, and that's basic earning power. Basic earning power is fundamentally a different idea that we're looking at. Here we're not comparing anything to sales, we're looking at profitability, specifically operating profit, and we're comparing it to total assets. Total assets represents the entire size of the firm, and EBIT is our operating profit. Now you might wonder, why are we using operating income here instead of net income? I mean, we are concerned about net income, right? Oh yes, we're concerned about it, and in fact, in a couple of minutes, we will look at that. Okay, we will have a very important ratio that takes net income compared to total assets. But why do we do this? Why is this also important? Well, because sometimes you may really want to compare two firms based on operating profit and not based on net profit. Why is that? Well, because you may want to be looking at the relative performance of two managers, and perhaps those managers are not really in control of things like financing, which affects your interest expense. And you know, these two firms might actually even have very different financing strategies and therefore different levels of interest expense. And for that matter, they might also be in different tax brackets. You don't know. And so if you're just trying to compare two companies based on their operating performance, and you don't want to be looking at the financing cost and at the tax situation, then you might want to look at basic earning power as a measure of overall profitability. So this is pretty easy to do. EBIT is your operating income. There you've just got to get that from the income statement and then divide that number by total assets from the balance sheet. That's pretty easy to do, and if you do so, you'll get about 14% for DeLeon. Now going over here to the page we were on before, we'll see that basic earning power actually still leaves a bit to be desired. Okay, it was below the industry average. The industry average is about 19%. It was below that, had a really bad year, and now it's rebounded, but it still looks like it needs some additional improvement in this area. Now, how are you going to improve a ratio like this? How are you going to improve any ratio for that matter? Well, a ratio is one thing divided by another, right? You've got a numerator divided by a denominator. So the numerator is the top number, the denominator is the bottom number. To increase the ratio, if that's what you want to do, and we would like to see that, you have two choices. You can increase the top number, that is, you can increase EBIT, or you can decrease the bottom number, or you could do both. But you have to do at least one of the two in order to increase the ratio. So what is it for DeLeon exactly in this case? Is it more that they need to increase the top number? They need to increase operating income? Well, while that wouldn't be bad, it's probably not the main thing. Okay, you'll notice up here that operating margin also relied on this EBIT number, and it actually seemed okay, right? It was right about the industry average. But compared to total assets, the EBIT doesn't look so good, as the basic earning power is below average. So it may be that total assets are too large, so to speak. It may be that the company has some assets that are sitting around not being as productive as they should. And you know, that actually goes back to what we said earlier when we were talking about the total asset turnover and how the company had probably some inefficiently used current assets like accounts receivable and inventory. So it does look like there is some problem in that area for DeLeon that it needs to look at, and that could be affecting its basic earning power ratio. Alright, now there are two other very important profitability ratios that I definitely want you to know. and that's return on assets and return on equity. These two are very important because it kind of all boils down to this, especially if you're looking at profitability. Return on assets is net income, a very important number that we want to see high in general, and comparing that to total assets of the firm, the size of the firm. So this is going back to that question of how profitable is the company given its size. And we like to see that number higher because it means generally that we're generating a higher amount of return on perhaps the same or smaller level of investment by the company's stockholders, by its lenders, all the company's investors. Sometimes we refer to this as the return on investment. And in this case, we would take the net income from the income statement, of course. It's about $253,000 or $254,000, and divide by the total assets from the balance sheet. When we do that, we get about 7%, 7.3% to be exact. Okay, we might also want to ask the question, we might want to focus a little bit more not just on total assets and on all the investors, but because as managers we're supposed to be thinking about shareholders, we might want to focus on stockholders' equity, okay, total common equity. So in this case, we might calculate return on equity if we were particularly wanting to look at it from a shareholder's point of view, and take net income divided by total common equity. Obviously, you can get your net income from the income statement, just like we had before. All right. Here's our income number at the bottom of the statement. And then we would also look at total shareholders' equity. Okay. Here's the shareholders' equity section, and total equity is right here. Just a little under $2 million. So a net income of $254,000 approximately, divided by total common equity of just short of $2 million. Divide those two numbers and we get 13%. Mathematically, this number should always be bigger in magnitude than the other. All right, ROE should be bigger in magnitude than ROA. But that's just a multiplier effect. It doesn't mean that ROE is better than ROA. We can look and see how DeLeon looks in this area. ROA and ROE have been below average, and of course in the second year they weren't good at all. The company had a loss in that year, and so with a negative profit figure you're going to get a negative ROA or ROE. You never want to see that. But in the most recent year, it seems to have rebounded, but it needs to rebound more. The industry average for ROA is 9.1%. For ROE, it's 18.2%. We're still not quite back to where we should be. So more improvement is needed for DeLeon in this area.